90% of investors lose money, not because the market failed them, not because they were unlucky, because of something nobody ever warned them about. And by the time most people figure it out, it is already too late. I want to ask you something honest. Have you ever made a financial decision, that you knew in that exact moment was probably wrong and made it anyway? If the answer is yes, you are not alone. You are human. And today, we are going to talk about exactly what that costs you, not in theory, in real numbers, real patterns, real decisions that real people make every single day that quietly destroy the financial futures they were trying to build. This is not a video about the market. This is a video about you. And what you are about to understand changes everything. This is the bigger picture. Let me take you back to a specific moment. Not a market crash, not a headline, not a number on a screen, a feeling. The feeling of watching something you own lose value. Slowly at first, then faster. The green turning to red. The number that represented months of work, of sacrifice, of delayed gratification, shrinking, day after day, week after week. And somewhere in that process, a voice arrives. Quiet at first, then louder. Get out, stop the bleeding, do something. That voice is not your enemy. It is trying to protect you. It was built over millions of years of evolution to protect you from predators, from famine, from threats that required immediate and decisive action to survive. The problem, is that the stock market is not a predator, and the instinct that kept your ancestors alive is the exact instinct that destroys most investment portfolios. There is a name for this. In behavioral finance, it is called loss aversion, and it was documented in one of the most important studies in the history of economic research. In 1979, psychologists Daniel Kahneman and Amos Tversky published findings that would eventually win the Nobel Prize in economics. Their discovery was simple and devastating. Losing $100 feels approximately twice as painful as gaining $100 feels good. Read that again, slowly. The same amount, opposite directions, two completely different emotional intensities. This asymmetry, this gap between how loss feels and how gain feels, is not a character flaw. It is not weakness. It is not something that more discipline or more experience or more knowledge will ever fully eliminate. It is wiring, deep, ancient, operating beneath every financial decision you have ever made, whether you knew it or not. And here is where it becomes expensive. Markets do not move in straight lines. They never have. They drop 20%, recover, climb 30, pull back 15, and over decades, they compound upward into something extraordinary. But the investor who feels every drop twice as intensely as every gain does not experience that journey the way the data does. They experience it in their body, in the tightening in their chest at 3 in the morning when they check their phone and see red across the screen, in the jaw that clenches when the news anchor says the word recession, in the impulse, immediate, powerful, almost physical, to do something, anything, to make the feeling stop. And that impulse is where the money goes. During the market crash of 2008 and 2009, retail investors pulled approximately $200 billion out of equity funds. $200 billion they sold at the bottom. Then, as markets recovered through 2010 and 2011, they watched from the sidelines, waiting for certainty that never quite arrived. And when they finally felt safe enough to return, they bought back in, at higher prices, after missing the entire recovery. They did not lose money because the market failed them. They lost money because their nervous system was making financial decisions. And here is the part that changes how you see everything that follows. The industry knew. The data on investor behavior has been available for decades. The pattern is consistent across markets, across countries, across generations of investors who repeated the same cycle with remarkable precision. And yet the platforms, the products, the entire media ecosystem built around investing was not designed to protect you from this pattern. It was designed to keep you engaged with it. Because an investor who checks their portfolio once a quarter, BK, makes fewer decisions, generates fewer transactions, produces less revenue for the institutions that depend on your activity to generate their profit. The nervous investor, E, is the profitable investor, not for themselves, for everyone else. There is a particular kind of mistake that is almost impossible to catch in the moment. Not because it is hidden, not because it requires special knowledge to identify, not because it only happens to people who are careless or uninformed, but because it feels exactly like the right thing to do. It feels like experience, like caution, like wisdom earned the hard way. And that feeling is precisely what makes it so expensive. The first trap has a name, anchoring. And once you see it clearly, you will recognize it in almost every financial decision you have ever made. Anchoring happens when the brain assigns disproportionate weight, chi, to the first number it encounters, and uses that number, chi, as the reference point for every decision that follows. Here is how it plays out in real life. You buy a stock at $60, it drops to $40. And instead of asking the right question, is this company worth owning at $40? You ask a completely different question. When will it get back to 60? 60 was never a rational reference point. It was simply the first number you paid. But your brain attached to it, like anchored to it, and now every decision about that position is filtered through a number that the market has already decided is irrelevant. This is why investors hold losing positions far longer than they should. Not because the math supports it, because the brain cannot accept that the original price was just a price, not a promise. The financial industry understands anchoring deeply. It is why products are presented with an original price and a discounted price. It is why analysts publish price targets, giving investors a reference point that shapes behavior long after the underlying reality has shifted. The anchor is always someone else's number, used to influence your decision. The second trap is called confirmation bias, and in the age of algorithms and personalized content, it has never been more dangerous. Confirmation bias is the tendency to seek out, remember, see, and trust information that confirms what you already believe, and to discount, forget, or dismiss information that challenges it. Every investor has a thesis, a story they tell themselves about why their portfolio makes sense, why the stocks they own will recover, why the sector they have bet on is misunderstood by the market and will eventually be recognized. And the internet, Ashi, with its infinitely personalized feeds and recommendation algorithms, OPC, is extraordinarily good at finding people who agree with that story. Forums full of investors holding the same positions, analysts making the same case, headlines that confirm the thesis, and bury the counterarguments 3 pages deep in a report nobody reads past the summary. The investor feels informed, researched, confident. But they have built an echo chamber around a decision they made months ago and called it due diligence. The third trap has the least dramatic name and costs the most money. It is called inertia, and it operates not in the moments of panic or euphoria, but in the long, quiet stretches between them. Inertia is the reason people stay in high-fee funds for decades without questioning whether better options exist. It is the reason asset allocations set at 40 years old are still in place at 60, without adjustment for a completely different risk profile and timeline. It is the reason the default option in a retirement account, NAS, chosen by an HR department on a Tuesday afternoon 15 years ago, is still generating returns today. Not because it was the best choice, because changing it requires effort, and effort requires attention, and attention is always going somewhere else. A study by Vanguard found that investors who never rebalanced their portfolios, underperformed those who rebalanced annually by an average of 1.5% per year. Over 30 years, that 1.5%, compounded, is the difference between retiring at 65 and retiring at 72, 7 years of your life, lost not to a market crash, not to fraud, not to bad luck, to inertia. These 3 traps, Anchoring, confirmation bias, inertia, are not character flaws. They are not signs of weakness or ignorance. They are the predictable outputs of a brain doing exactly what it was designed to do, in an environment it was never designed for. And the investors who escape them don't do it through willpower. They do it through structure, which is exactly where we are going next. Let me tell you about the most boring investment strategy in the world. You automate a fixed amount every month into a low-cost index fund. You never check it when the market drops. You never celebrate when it rises. You never move it. Never adjust it based on the news. Never let the headline of the week change the direction of the decade. You just let it be. That strategy, has outperformed the vast majority of professional fund managers over every significant time horizon ever studied. Not occasionally, consistently, not in some markets, in almost all of them. And yet almost nobody follows it because it feels wrong and it feels passive, irresponsible, like you are not paying enough attention, like someone who cares about their financial future should be doing more, watching more, adjusting more. That feeling is the trap. Let me give you a number that will stay with you. There is an internal study from Fidelity Investments that examined which customer accounts delivered the best performance over a 10-year period. The results were remarkable. The top-performing accounts belonged to customers who had forgotten they had an account or who had died. Not as a metaphor, literally. Dead investors outperformed active ones because they couldn't react, they couldn't panic, they couldn't log in at 3 in the morning and make a decision driven by fear instead of strategy. The best investment plan for most people, is the one that protects them from their own reactions. So what does that structure actually look like in practice? The first element is automation. When investment decisions require a conscious act, they become vulnerable to every trap we discussed, to loss aversion, to anchoring, to the confirmation bias flooding your feed the moment markets turn volatile. But when investment decisions are automated, they happen regardless of how you feel on the day they execute. Your contribution goes in on the first of the month. Whether the market is up or down, whether the week was good or devastating, whether you feel confident or terrified. The decision was made once, structurally, and then removed from the daily weight of your attention entirely. Automation does not eliminate risk. It eliminates the most expensive variable in your portfolio, you. The second element is simplicity. A portfolio of 3 low-cost index funds, day, broad market, international, bonds, held consistently for 30 years, outperforms the vast majority of actively managed funds. This is not a controversial statement in academic finance. It is one of the most replicated findings in the history of the discipline. SPIVA, the S&P Indices versus Active Scorecard, publishes data every year on how active fund managers perform against their benchmark index. Over a 20-year period, approximately 92% of active large-cap fund managers, underperform the S&P 500, 92% of professionals, with teams of analysts with proprietary research, with decades of experience. Underperformed by an index that requires no management, no insight, and charges a fraction of a percent per year in fees. The complexity is not the product. The complexity is the price. The third element is written rules. Before the market moves, before the volatility arrives, before the headline that makes your stomach drop at 7 in the morning, write down your rules. What percentage drop will you tolerate before reviewing your allocation? What conditions would actually justify selling a position? What is your investment horizon? And what does that mean for how you interpret short-term movements? Writing these rules when you are calm means you have something to return to when you are not. It creates distance between the emotional impulse and the financial action. And that distance, measured sometimes in just 48 hours, is worth more than almost any market insight you could develop. Because the investor who acts on a rule they wrote 6 months ago is a fundamentally different investor, than the one reacting to what happened this morning. One is navigating, the other is surviving. And the difference between those two modes, over 30 years, is everything. There is a moment every investor faces eventually. It arrives differently for each person. Sometimes it comes with a market crash, RC, a sudden violent drop that wipes months of gains in a single week. Sometimes it comes quietly, a slow bleed that stretches across months until the cumulative loss becomes impossible to ignore. Sometimes it comes from outside the market entirely, a job loss, a medical bill, a conversation with someone whose portfolio seems to be doing everything yours isn't. But whenever it arrives, and however it looks, it carries the same three words. This time is different. Those three words are the most expensive words in the history of investing. They have preceded every panic sell at the bottom of every major market correction in modern history. They were spoken in 1987, in 2000, in 2008, and in 2020, and every single time they were wrong. Not because the crisis wasn't real, the crashes were real, the pain was real, the uncertainty was genuinely terrifying in the moment, but the conclusion the brain drew from that pain, that this time the rules of long-term investing no longer applied, was wrong. Every time. Here is what the data shows about market recoveries. After every single market decline of 20% or more in the last 100 years, the market has recovered. Not quickly, not comfortably, not without further pain along the way, but it has recovered, and it has gone on to reach new highs. The investor who stayed captured that recovery. The investor who sold locked in the loss, and then faced the second most difficult decision in investing, when to get back in, and that decision is almost always made too late. A study by JP Morgan found that if you missed just the 10 best trading days in the market between 2002 and 2022, your returns were cut in half, 10 days. Out of more than 5,000 trading days in that period, the best days in the market, almost always follow the worst ones. They arrive in the middle of the chaos, when the headlines are still screaming, when the recovery feels impossible, when getting back in feels like the most irrational thing imaginable. The investor is sitting on cash, waiting for a certainty that never comes, misses them entirely. Now let's talk about something that doesn't get discussed enough: the social dimension of investing and how dangerously it shapes decisions. Humans are deeply social creatures. We calibrate our sense of success, our sense of safety, our sense of what is normal against the people around us. And in the age of social media, the people around us include strangers on the internet with highlight reels carefully curated to project maximum success. The investor who made 400% on a single trade in 2021 posted about it. The investor who lost everything on the same trade did not. What you see in financial forums, in investment communities, in the comment sections of financial content, is a systematically distorted picture of reality. Success is visible, failure is private, and the gap between what you see, and what is actually happening across the full population of investors creates a benchmark that is both false and devastating. Because when your carefully constructed, boring, automated index fund portfolio returns 8% in a year, and your feed is full of people claiming 20, 30, 50% returns, 8% feels like failure, and that feeling of falling behind, of missing something, of not being aggressive enough, is one of the most reliable triggers for abandoning a sound strategy in favor of a reckless one. This is not a coincidence. Platforms are designed to generate engagement, and nothing generates engagement in financial communities like extraordinary claims of extraordinary returns. Your job as an investor, is to remember that you are not competing with those claims. You are competing with your own financial future. And your own financial future does not care what someone on the internet posted on a Tuesday. I want to tell you about a specific kind of investor, not a genius, not someone with access to information that others don't have, not someone who predicted the crash, or timed the recovery, or found the stock that nobody else was watching. Someone ordinary with an ordinary income, an ordinary life, and an extraordinary result. Because here is what the research consistently shows. The investors who build genuine wealth over time are almost never the smartest ones in the room. They are the most consistent ones, the ones whose strategy keeps working. Even when their emotions are screaming to override it, even when the headlines are terrifying, even when everyone around them seems to be doing something different, especially then. So what do they actually do differently? The first thing is that they separated their identity from their portfolio. Most investors experience their portfolio as an extension of themselves. When it goes up, they feel smart, capable, vindicated. When it goes down, they feel foolish, exposed, like they have failed at something fundamental. That emotional attachment is one of the most expensive things you can bring to an investment account, because it means every market movement is personal. Every red day is a judgment. Every green day is a temporary relief, and decisions made from that place are almost never good ones. The investors who win over time treat their portfolio the way a farmer treats a field. You plant, you water, you protect from obvious threats, and then you leave it alone. Not because you don't care, because you understand that growth, real growth, happens in the quiet, not in the watching. The second thing they do differently is that they defined what enough looks like before they started. Most investors are chasing a number they never clearly defined. More, always more, never quite enough. The target moving forward at exactly the pace of their progress, always just out of reach. This is not ambition. This is a trap. Because an undefined destination, yibis, produces infinite anxiety and zero satisfaction. The investors who build genuine wealth, and more importantly, genuine peace around that wealth, sat down at some point and answered a specific question. What am I actually building toward? Not a fantasy, not a number pulled from a retirement calculator. A real answer, grounded in the actual life they want to live, the actual freedom they are working toward, the actual number that would make the word enough feel true. That answer changes the strategy. It changes the risk tolerance. It changes how you respond when the market drops 20%. Because instead of asking, am I losing? You ask a different question. Am I still on track? And those two questions produce completely different investors. The third thing is that they stop trying to be right. Most investors are playing a game of being right, finding the stock that will outperform, predicting the sector that will lead next quarter, identifying the moment to get in and the moment to get out. Being right feels good. Being wrong feels terrible. And so the entire energy of the investment process gets redirected toward a goal that has almost nothing to do with building wealth. The goal of not being wrong. The investors who win over time, i.e., stopped playing that game entirely, they accepted, early and completely, that they would not predict the market, that nobody reliably does, that the energy spent trying to be right was energy taken directly from the only strategy that actually works: consistency, patience, time. These are not exciting words. They do not generate clicks or followers or the particular thrill of feeling like you have found an edge. But they are the words that appear over and over and over again in the financial histories of people who built something real, not because they were lucky, because they were boring, in exactly the right ways, for exactly long enough. And that is a skill, one that can be learned, one that can be practiced, one that begins with the decision to stop performing as an investor and start actually being one. If you are still here, I want to stop for just a moment, not to interrupt what we are building together, but to acknowledge something real. Most people who start a video about investing are looking for a tip, a stock, a sector, a number, something actionable they can take into the market tomorrow and feel like they are doing something. You stayed through a conversation that offered none of that, and that tells me something important about you. You are not looking for a shortcut. You are looking for understanding, real understanding, the kind that changes not just what you do with your money, but how you think about it. That is rare, and it is exactly what this channel was built for. So if this conversation has shifted something, if something here has landed differently than most financial content you have encountered, I want to invite you to stay close. Subscribe to this channel, not for tips, not for predictions, not for the excitement of someone telling you what to buy next week, for the bigger picture. The kind of clarity that builds slowly, video by video, conversation by conversation, until one day you realize that the financial world, which once felt confusing and intimidating and somehow always working against you, has become something you navigate with confidence. That transformation takes time, but it starts with a single decision: stay, subscribe. So the next part of this picture reaches you when it is ready, and share this with one person in your life who needs it, someone who is working hard, watching their investments and feeling that something is wrong, but not knowing exactly what. This conversation might be exactly what they need to hear. And now, let's finish what we started. Because there is one more piece to this picture. One more thing that separates the investors who build something real, from the ones who spend decades trying and arrive at retirement wondering where it all went. We have talked about loss aversion, EK, and how it hijacks decisions at exactly the wrong moment. We have talked about anchoring, confirmation bias, inertia, and how each one feels like wisdom while functioning like an anchor. We have talked about structure, automation, simplicity, written rules that protect you from yourself when you need protection most. We have talked about the investors who win and what they actually do differently, not smarter, not luckier, more consistent, more patient, more willing to be boring for exactly long enough. But underneath all of it, there is something we have not yet named, something that connects every element of this conversation, into a single truth. A truth that is simple enough to say in one sentence, and deep enough to take a lifetime to fully understand. The market does not determine your financial future. You do, not through prediction, not through analysis, not through finding the right stock or the right moment or the right advisor with the right track record. Through the quality of your decisions, in the moments when decisions are hardest to make well, in the drops, in the panic, in the silence of a Tuesday morning when nobody is watching. And the easy thing and the right thing are pointing in completely different directions. That is where your financial future is actually written, not on Wall Street, in those moments. And what we are going to talk about in the final part of this conversation is how to be the person who chooses correctly in exactly those moments, even when it is hard, especially when it is hard, and everything to do with it. There is a study that has always stayed with me. Researchers followed a group of people over several decades, tracking their decisions, their outcomes, their financial trajectories, and at the end, they asked a simple question: what was the single biggest factor that separated the people who built lasting wealth from the people who didn't? Not intelligence, not income, not timing, not luck. The single biggest factor, was the ability to remain calm in moments designed to produce panic. Read that again. Not smarter, not richer, not better informed, calmer. The ability to feel the fear, acknowledge it completely, and then make the decision that the fear was trying to prevent. That ability is not a personality trait you either have or don't. It is a skill, built slowly, practiced deliberately, strengthened every time you choose the long view over the immediate relief of doing something, anything, to make the discomfort stop. Every investor loses money at some point, every single one. The market does not distinguish between the careful and the careless, the experienced and the novice, the humble and the arrogant. It moves, sometimes violently, sometimes without warning. sometimes in ways that feel deeply personal even though they are completely indifferent. What distinguishes the investor who builds something real is not that they avoided the losses. It is what they did in the moment the loss arrived. They felt it. They did not minimize it or pretend it didn't matter or perform a confidence they did not feel. They felt it fully, and then they did nothing. Not because they were passive, because they understood something that most investors never learn. That the market's job, is to transfer money from the impatient to the patient. And that every moment of panic, every impulse to sell, every headline designed to make staying feel irresponsible is simply the mechanism of that transfer in motion. The question is never whether the transfer is happening. It is always which side of it you are on. You came into this conversation as someone trying to understand why most investors lose money. You are leaving with something more valuable than the answer to that question. You are leaving with the understanding that the answer was never about the market. It was always about the investor, about the moment between stimulus and response, about the quality of decisions made in conditions specifically designed to produce poor ones, about the quiet, unglamorous, deeply unsexy work of building something real over a long period of time by someone who understood that patience is not the absence of action. It is the most powerful action available. That understanding is yours now. It does not expire. It does not require a subscription or a brokerage account or a minimum balance. It requires only one thing: the willingness to use it in the next drop, in the next panic, in the next moment when the easy thing and the right thing are standing at opposite ends of the room and waiting to see which one you walk toward. Walk toward the right thing every time, not perfectly, but consistently. And over time, consistently, becomes everything. If this conversation has been worth your time, share it with 5 people who are investing right now and feeling like something is wrong, but not knowing exactly what. This might be exactly what they needed to hear. Leave a comment below. Not to tell me what you thought. Tell me what you want to understand next. What part of your financial life still feels like a locked room? What question you have been carrying without knowing where to take it? Ask it here, because the next conversation starts with what you need most. This is the bigger picture: money, wealth, and the life you're building. We'll see you in the next one.